Across the risk return range, private credit is here to stay, it's here to grow, and I think everyone is finding their place across the risk reward spectrum. But stepping back, we're increasingly seeing a lot of potential in operationally driven businesses.
Andrew, thank you very much for being here today. We always like to start by asking you to introduce yourself and also an overview on your role at PGIM, please.
Well, it's a pleasure to be here and good to have the opportunity to chat. I joined PGIM just over 17 years ago to establish the real estate credit fund management platform, which now has grown to over $20 billion across US, Europe and Australia. My role is to coordinate the global strategies because we are truly global, where half of our business is actually outside of the US. In Europe, we focus on a barbell strategy to our investment approach. On the one side, investment grade style senior debt, and on the other side, high yield strategies that are seeking double-digit returns. So overall in Europe, we've done over 8 billion in the last 15 years. So, and we've invested in 11 European countries as well.
How are global lending dynamics evolving as traditional banks retrench and private credit funds expand their footprint across real estate financing?
So globally, there is a difference between the US, Europe, and Asian. And there are two parts to it. It's the real estate dynamics going on in those different regions, as well as the structure of the credit market. So if we first look at different drivers in the real estate markets, in the US, it's still a buying time theme. People aren't really wanting to trade. They don't want to sell. So there's still quite a lot of extend refinancing opportunity. We're also seeing a lot of what we're calling bridge finance in the US, where construction is finished and there needs to be a phase of lease up that the banks used to be able to do but aren't doing anymore. And actually we're seeing new developments come into the markets, people trying to take the opportunity there. In Europe, it's very much a supply story of very heavily undersupplied regions across all sectors. So it's supplying into a lot of development, construction, term out financing into the European market. And in Australia, it's a demand-driven story from growth and economic growth and immigration. In terms of the providers of capital, the US is very, very mature. Less than half of their capital comes from their banks. They have a healthy securitization market. The insurance companies have been very, very active. They also have the agencies, which are government-backed providers of capital. So it's quite a diversified pool of capital that property companies have to go to. In Europe, it's still 85% banks, 15% everywhere else, but that is evolving. And for example, I think this year, nearly 40% of all new lending in the UK was from alternative lenders. So we see that trade. Europe's got a bit more to catch up with. But I think across the risk return range, private credit is here to stay. It's here to grow. And I think everyone is finding their place across the risk reward spectrum.
Are investors moving up the capital stack towards to senior lending for safety or down into mezzanine and preferred equity for enhanced returns?
Yeah, it depends on the investor. So you have different ranges of investors. If I take a sort of majority view, so if we go on the senior debt, the lower risk return, we're looking at fixed income investors, looking for a premium over and above public bonds. So generally you have a lot of insurance companies in that space where it's equivalent to a rated bond, where it's very, very capital efficient. If you then move beyond that, still an attractive place for insurance companies, but below investment grade, I call that almost real estate direct lending. That's sort of mid to higher single digit lending, senior debt, use of leverage to increase returns, but it's still senior debt, taking some leasing risk. And the third area going towards double-digit returns require risk. That's a very broad range of investors, which now include your sovereign wealth funds, your big pension funds, endowments, and increasingly looking at the global private wealth market that requires those sorts of returns. So I think rather than looking at a particular credit structure, it's a combination of everything. So the high yield strategies can do senior debt, levered senior debt, mezzanine, pref equity, kickers. So rather than looking at the actual credit structure, it's the overall risk of all the deals. And the key factor is the amount of development any one of those strategies is prepared to take on.
Now let's talk about sectors and regions as well. Where do you see the best opportunities when it comes to debt investments?
I think, again, you're looking through to the underlying real estate. I mean, I'm having done this for 15 years on the debt fund side, the exit is critical. So when we look at the exit, there are two factors really in play in a cyclical market. First, investor liquidity. What do investors want? Now, in Europe, we haven't got the most liquid, healthy transaction market at the moment. So your routes to exit some of our deals are both someone buys the property, or B, a bank or another lender is prepared to lend on it. So essentially where we look at opportunities are in those liquid sectors. So across the living sectors, there's still opportunities in the UK, and that's been driving the European market a long time. But Spain is really showing up, particularly in the student sectors, as an undersupplied sector, and also a huge influx of foreign students, which normally drive that market into Spain. I think there's a lot of ground to be covered in logistics across Southern Europe and even into Germany still. E-commerce penetration hasn't reached the levels of the UK. But stepping back, we're increasingly seeing a lot of potential in operationally driven businesses. So all the residential businesses are operationally driven. We only deal with developers that actually operate their own properties. Co-living is something I think is going to perform very, very well from a rental growth perspective. Senior living, so care homes. They've been a few false starts, but there are some very good operators now with new care homes that need funding. Again, they're finding it very, very difficult to fund. Then we got digital infrastructure, developing data centers, cold storage, supply chain, all very heavy operational that traditional lenders are finding difficult to finance. But at the end of the day, you need to be able to drive the income side, which is what do tenants want, what do occupiers want, generally brand new green property, and what do investors want, the same.
We are here in London with 100 plus leaders from the industry. What are the most relevant issues that you see being discussed during the coffee breaks? What's everyone talking about?
Cycle. On the positive side, I think everyone agrees we're in an interesting upward-looking part of the cycle. A lot of differences in what people think that cycle is going to look like. You know, some people thinking in a year's time we're back to the good old days, and other people thinking it's more sustained. So that's quite an interesting discussion. Obviously, talk about today and impacts today's budget may well have on the UK. I think everything's really been priced in. I think the third thing is where valuations stand, for example, in Germany, and where transactions in the bigger markets start showing where real values are. So I think cycle, transactions, real values, and obviously a lot of just talk about what on earth is going to turn up today.